Hey everyone, welcome back to Finance with Manvi. If you're new here, make sure to hit that subscribe button to stay updated with the latest in finance. Today we're diving into the 5 common investment mistakes that beginners often make. If you want to build wealth and avoid losing money, stay tuned as we break these mistakes down and give you actionable tips to avoid them. Let's get started. So, for our agenda today, we're going to be covering the 5 mistakes: emotional decision making, not diversifying, ignoring inflation, following trends without research, and starting too late or being too cautious. Mistake number 1: emotional decision making. First up, let's talk about how emotional decision making. It's natural to feel anxiety when the market dips, or excitement when it's soaring. But when you let emotions control your decisions, you're likely to make costly mistakes. For instance, during a market dip, many beginners panic and sell off their investments, locking in losses. Or they buy into a stock when it's peaking, hoping to make quick profits, only to see the price crash. Tip: the key to avoiding emotional decisions is having a long-term strategy. Set clear financial goals and stick to them. Instead of reacting impulsively to to market movements, trust the process. This helps you ride out the volatility without making rash decisions that could hurt your wealth. Mistake number 2: not diversifying investments. Next up is not diversifying your investments. Well, beginners make the mistake of putting all their money into one stock or one type of investment. While it's risky or tempting to go all in one, something that you believe in, if that investment drops in value, you're in really, really, really big trouble. So basically, don't put all of your money into one single investment or stock, because if that stock drops or it just reduces, basically gives you a huge amount of trouble to deal with, making it a huge risk. Diversification is one of the most important strategies to protect your portfolio, of course. So, a tip is by spreading your investments across different asset classes like stocks, bonds, real estate, and even alternative assets like cryptocurrencies. You're reducing the risk that one bad investment will affect your whole portfolio. This way, even if one area underperforms, other assets in your portfolio can balance it out and minimize your overall risk. Mistake number 3: ignoring inflation. Now let's talk about inflation. Many new investors underestimate how much inflation impacts their savings. Let's say you've been saving money in a low interest savings account, thinking it's safe. While your account might be growing, inflation is slowly eroding the purchasing power of your money. For example, if inflation is 3% per year and your savings earn just 1% interest, you're actually losing value over time. Tip: to beat inflation, consider investing in assets that generally grow faster than inflation, such as stocks, bonds, real estate, or index funds. These investments are more likely to provide a return that outpaces inflation and helps you and your money grow in real terms. Don't let inflation silently eat away at your wealth. Mistake number 4: following trends without research. The fourth mistake is following trends without doing proper research. Social media and online platforms often hype up stocks or cryptocurrency, making them seem like the next big thing. It's easy to get caught up in the buzz, but it's not easy to get out of it. In the buzz, but and thinking you'll make a quick profit by jumping in. But often these trends are short-lived. When you invest based on what's trending without understanding the underlying asset or its risk, you can end up losing money when the hype dies down. Tip: always do your own research before investing in any asset. Don't trust other people's research before doing your own. Look at the company's fundamentals, its business model, and even its market outlook. Never invest in something just because it's trending. Understand the risk and evaluate whether it aligns with your investment strategy. Knowledge is your best defense against getting burned by these short-term fads. Mistake number 5. Starting too late or being too cautious. The final mistake. Many beginners are hesitant to start investing because they feel they need a large sum of money or they worry about making mistakes. The truth is, the earlier you start, the more time you have for your investments to grow. When you delay investing, you miss out on the power of compound interest, which can significantly boost your wealth over time. Tip: don't wait for the perfect moment or the perfect amount of money. Start with what you have, even if it's just a small amount. The sooner you begin, the sooner you'll start seeing your money grow. Consistency is the key. Making investing a habit and let compound interest work in your favor. And don't forget, we cannot leave without a quote of the day. The stock market is filled with individuals who know the price of everything but the value of nothing. Philip Fisher. This quote emphasizes the importance of understanding the value behind investments rather than just reacting to market movements, which ties in perfectly with the idea of avoiding emotional decision making, following trends without research, and the importance of a well-researched, diversified investment strategy. Thank you so much for listening, and there you have it. 5 investment mistakes to avoid if you want to build wealth. Well, remember, it's all about having a strategy, staying informed, and being patient. Stick to your plan, diversify, invest early, and don't follow trends without doing your own research. If you found this video helpful, give it a thumbs up. Subscribe to Finance with Munvi for more finance tips. And leave a comment below if you have any questions or thoughts. Thanks for watching, and I'll see you in my next video. Goodbye, and I will hope to see you.